Welcome to the Wealth Acceleration Podcast with your host, Wealth Coach Wade Reed.
Hey, what's up, Money Masters? It's Wade Reed back for another episode of the Wealth Acceleration Podcast. And today we're going to talk about the third component of my four-step system. Remember, that is called O.S.O.M, O.S.O.M. Organize, systemize, optimize, maximize. When we want to have success with money, we want to be awesome with our money. So we need to follow this four-step system. And this is the third component. We call it optimization. Now, this is an interesting one because it's actually quite meaty and there's so many cool things that we get to do when we start to optimize our money. Okay, let's talk about this. How do we do that though? The only way we can optimize something, we've got to define this a little bit. Optimization is about efficiency. Optimization is about efficiency. So here's a silly example. I've got kids who are vacuuming the floor today, and the thing that picks up and agitates the floor was not working properly. It was sucking air, and so like surface stuff could get on, but unless that thing's rotating properly at the right speed, at the right level, it's not optimized. It's not getting the most out of the power of the motor and the suction capabilities. So we cannot optimize it unless we know what's happening with it. So historically, we know it's been working. We know the child is capable of doing this task. There's a bit of a system in place. And then it's a matter of checking on things to make sure they're in the best possible efficiency. So when it comes to money, we're talking about you've gotten organized. You've gotten this financial organization document that I've got for you. You have been tracking your money for a while, so you know what your average expenses are pretty well at least. And so you've put the system in place and you're practicing the skill of using the organized data you have to become aware of what you have. And you know what's flowing in and out, and now it's a matter of tweaks and improvements that can take place. This is the really fun part about personal finance, actually. This is the part where as we increase our knowledge base, like some of these books on my shelf here that you might read, Rich Dad, Poor Dad, one right below my right shoulder here. This is one on mindset mostly. There's not much that's super practical in there. There's one called Think and Grow Rich, which is also a mindset book. There's one that's not on my shelf, but one of my favorites called The Richest Man in Babylon by George Clason. It is a classic. It's a really interesting parable about how to become successful with money. It's pretty practical. Of course, this one above my shoulder called Heads I Win, Tails You Lose by one of my colleagues and friends, Patrick Donahoe. It's super practical. It's a really good treatise on the monetary system that we're all dealing with and some of the pros and cons of using qualified plans like 401ks and IRAs compared to the use of adding whole life insurance, and how things like that can actually meld together to be more efficient, to be optimized in how we do our retirement income planning at some point, creating an income from assets that we create. There's books on my shelf like about business entities and how to be efficient with business entities. There's so many cool things that can be done here. So I'm going to go through some of the meat and give you some ideas on how to optimize. And we're not going to, of course, get personalized to your specific stuff, but I'm going to share with you a few anecdotal stories about ways over the years that I have seen consistently work to improve your cash flow, to improve your tax costs, reducing tax costs, as well as some ideas on insurances, how to make sure you get the most out of your insurance, biggest bang for the buck. Okay, so let's dive in. First thing that comes to mind for me as we think about this stuff is tax strategy. So I've got a book behind me. Pull it up here for those who are watching visually. It's called Tax-Free Wealth by Tom Wheelwright. Tom Wheelwright is a CPA. He's one of the advisors to Robert Kiyosaki. Robert Kiyosaki, again, if you're watching visually, you're seeing on the screen here a book called Rich Dad, Poor Dad. It's probably the most popular book on personal finance that I'm aware of, at least, and it's probably had the most print copies. One of the most influential books on the topic, period. Shifting our thinking about how wealthy people think versus how the typical middle class or poor mindset thinks. And that mindset is largely about buying things and depleting value. Those who are in a wealthier, more abundant mindset are thinking about controlling assets, being a good steward or manager, recognizing it's not really yours. Oftentimes, I don't know if you guys experience this, but I don't. When I was a kid and even sometimes as an adult, when I have something that's really mine, Sometimes if I'm angry or I'm upset about something, I'm willing to break that thing. I know as a kid, I used to throw stuff. As an adult, I've tempered that. But there are times when I want to break something. There's a stick in the yard. I own this yard. Of course, that's not going to really hurt anything. So I break the stick. It kind of feels good to do that. Sometimes we do that with money. We're like, man, I'm so upset that I have to pay taxes. I just want to go spend some of my own money and do something fun for once. And then we end up in debt. Man, I'm so sick of scrimping and saving. I barely have enough to get by. I'm going to go on this really nice trip. And then we're in debt. And it's a lot like we're stuck in this mentality that we don't have much control over our lives. And so I want to also influence you today to recognize the importance of when we're optimizing things, we're in control. Like we have some control over our financial life. So aside from mindset, that's part of organize. When we read books like what I just shared with you, that's organize. We're organizing our thinking into something productive, something that's going to be super beneficial for us. So once we have that more positive mindset, hopefully you're starting to shift that way. If you're attracted to this podcast, I'm sure you're starting to become a student of money. I'm going to reiterate that over and over and over again. And all that I talk about is we have to become students of money. It doesn't just happen. We are the producer of the income in our lives. We're the ones creating the value for other people, whether it's to an employer or to customers or clients. And in exchange for that value, you are getting a receipt we call money. The dollars that end up in our bank account, the checks that come through our hands that get into our bank account, the Venmo transactions, the credit card transactions that then get transferred into our bank account. All of those dollars in the bank account are a receipt of value, a temporary holding place for value exchanged with somebody else that now you are responsible for. It's really not yours. I want you to have the mindset that this money is not really mine. I'm a steward, meaning a manager. I'm responsible to take good care. And if you can have that mindset of this is somebody else's, and I'm a believer in God, I believe that all that I have, I am responsible for as a gift from Him to take good care of, to care for my family. Some of you listening to this may not be believers in God, and that's okay. But if you can have the mindset, even if you just pretend that everything I have is not actually mine, but I want to be a steward over it, I want to be a good manager over it, you'll be less likely to waste it. You'll be less likely to spend frivolously. You'll be more likely to track and plan and organize, because if you can think of it as somebody else's, you're a caretaker for it, we tend to be more likely to do the right things. And if you go back to some of the stuff I've talked about, I even have this little course called the Personal Finance Essentials, where I talk about where the financial statements come from, called a income and expense report, a balance sheet, a cash flow statement, and what we call the company books, or the record of financial transactions that happen within an organization. Those financial documents are really important to the accountability around money, because larger businesses have boards of directors, and boards of directors often are in place because there are multiple stockholders who are not necessarily workers in the company, and those stockholders have given money to the company to help it operate and be successful. And in order to be accountable to those who are providing funding to the business so it can be successful, there need to be reports that can show the progress and the success of the organization. Those are things that we want to do personally as well. And that's why I've invited you guys to get yourselves financially organized, be tracking your income and expenses so you know what's going in and out. This financial organization document that I have for you, I often refer to as the financial scorecard. It has a place for your income and expenses and your assets and liabilities and your loan details specifically, and your financial team and your protection component of your financial life, which includes all your insurance products and estate planning and things like that. When we have all that in place, then we can start to make tweaks and optimize. Optimization is creating efficiency. It's getting more out of the same resources. So back to taxation. If you happen to be a business owner, and you're like me, who happen to be 100% owner of my company, and I'm in a service business, so this works a little more efficiently as a service business than maybe as a retail operator or as a real estate managing company or something like that. But if you happen to be in the service business specifically, oftentimes we can have an entity set up more often than not, we start with an LLC. An LLC is called a limited liability company. It can be any type of entity. It can be a sole proprietorship. It can be a single member LLC, which in essence is a sole proprietorship with just under a business name with a tax ID. It can become a partnership. It can become a sub S corporation, or it can be a C corporation. So there's 5 different things that you can have if you're a business owner. If you are operating under an LLC, and you want to get some tax savings, you can change it to an S corporation. And this is something I would recommend that you talk to your CPA about. And they should have some good ideas around this. If they're strategic oriented anyway, they'll have some good ideas around this. It's interesting though, I've had a lot of CPAs over the years who have poo-pooed this idea, stating that, oh, the tax code's going to change, so it's not really worth doing. It's more costly than it's worth. And yet I have other strategic minded CPAs who will say things like, are you kidding me? This has been pooed on for 20 years. Think of all those people who would have been saving a bunch of tax if they had followed this strategy 20 years ago to today. They've literally lost 5 to 15,000 a year by not doing this. So what it is an S corp. As an S corp, the difference between an S corp and an LLC is you can change the taxation on your income. Whereas an LLC, a sole proprietorship, you are single member LLC, which in essence is a sole proprietorship. You have all of your income, which is subject to self-employment tax. As a S corporation, you can pay yourself as an employee, and only your employee income that's considered salary is subject to that payroll tax. So let's assume you're making $100,000 a year for easy numbers. You're paying 15.3% payroll tax on that 100,000 if you're a sole proprietorship or you're an LLC acting as a single member LLC. 15.3%, that's $15,300. Dang, that's a lot of money. If you become an S corp and you're making that same 100,000, let's say 30 to 40,000 of that, let's just use 30, that's your salary. Now only 30,000 of the 100 is subject to that 15.3% tax. And I don't have that number memorized and I haven't run the math for you, so you'll have to do that yourself. 15.3% or 30,000 times 0.153. That will tell you what the tax is compared to the 15,000. So that other 70,000 on an S corp is taken as a distribution of profit or a dividend and is not subject to self-employment tax. And you say 15.3% on that $70,000. Again, this is just an example so you can get the numbers using fairly round figures. That's huge. It's literally in the realm of $5,000 to $15,000 depending on the type of business you're in and how much money you're making every single year. So that's an optimization thing that can be done, a strategy that creates optimization. Another thing you can do if you have children is pay your children. Children who are under 18 do not have to file a tax return. And every individual, regardless of age, the first, it's about $14,000 now. I'd have to look that up to verify, but it's going up with cost of living adjustments. So it's around $14,000 a year now that you can that you can earn and not have to pay any taxes. It's called your personal exemption. So if you're a business owner and you have children who are capable of doing something productive for the business, you can pay them. And the income that they earn is not taxable because it's under that $14,000 threshold. In essence, if you were going to pay for kids' things anyway, and you received all of that income yourself, you're going to pay 24 to 32% federal income tax plus your state tax plus possibly self-employment tax. So we're talking about 40% cost of money to then take the remainder and help pay for your kids' extracurricular activities. What if you are able to pay your children into a bank account that you're a joint owner of? You legit pay them. You write a check in their name. They've performed services. You've got documentation of those services. And you move that money into a savings account for them. And then when you need to pay for their expenses, it comes out of their account into your checking account, and then you pay for it. Now you get 100% of every dollar instead of only 60% of every dollar that's available to help fund the kids' future and the day-to-day things you're paying for anyway. Huge optimization piece right there. If you've got multiple kids, we're talking 14,000 times 0.24, 14,000 times 0.32. That's your federal income tax bracket, your percentage. That's the savings you're going to get if you're able to pass through money that would otherwise be taxable to you to your children instead. Huge. And again, this is something you need to talk to your CPA about to get the right strategy in place. Let's look at insurances. Now, this is something oftentimes people say, man, I hate paying for insurance. It's like a necessary evil. Holy cow, that's one of my worst phrases ever. Who wants anything that's necessary and who wants to do anything that's evil? Like, really? I know it's just kind of a play on words, but if words have meaning and semantics do matter, I'd rather have something that's my choice and that is good. My choice and that's good. I'd rather you choose into having protection rather than feel like you have to have protection. Now, the state does mandate auto insurance if you're going to drive an automobile. And I think that's a fair thing to do because there's a lot of accidents that happen on the road. And many people who don't have insurance are the ones who are the ones at fault. Even though it's a state requirement, oftentimes people still somehow get away with not having insurance. So we, as producers in this world, those who are in the mindset of doing more good and bringing more to the world than we take from the world, we want to have protection because it's way more efficient. So the first thing about optimization is having good insurance. Now, why does that actually matter? Because listen, if you break a car is $5,000 to $50,000, right? That's kind of big numbers, but it pales in comparison to if you injure a person. If you injure a body and there's concussion, there's broken bones, there's things that need surgeries, you're taking somebody's livelihood away. They can't work. They have to recover. The costs of medical care, you're talking in the hundreds of thousands of dollars. We were in an auto accident, my wife particularly with all of our kids. It turned into a 3-year situation and almost $200,000. We were rear-ended. The person had state minimums on their auto insurance. It paid out instantly within 2 to 3 weeks. And then we were wise enough to talk to our insurance agent about optimizing our own coverage. And he said, look, are you more likely to control yourself or somebody else when you drive? Well, duh, of course I can only control myself. So he said, look, you need to make sure you have uninsured and underinsured motorist protection on your automobile coverage. Make sure it's at least equal to what you have if you're at fault. So we bumped ours up from state minimums in 2010 up to 250,000. So instead of 25,000 of coverage, we had $250,000 of coverage. And then he said, to make this even more efficient, let's get you an umbrella policy that has an extra $1 million of liability protection for both if you're at fault for an accident as well as if somebody else is at fault and doesn't have sufficient coverage. That way, if they don't have the coverage, you have a backup that you can recover losses. And I thought, well, that makes sense. It's only $300 a year. We'll do that. So I 10 times my auto coverage, plus I added this extra $1 million of umbrella, and I added a renter's policy. Again, this was back in 2010 when I first had this optimization conversation. I was paying about $60 a month. Now I'm paying $120 a month. So while I doubled my premium for only $60 more a month, I 10 times my coverage. To me, that was a sweet deal to optimize my insurance. One of the ways I helped mitigate that, though, was I increased my deductible from $250 to $1,000. So instead of paying extra premium to have a lower deductible, because I had some savings on hand, I'd been following a system I'd been taught similar to what I'm teaching you guys. I had some cash on hand. So now that I have cash on hand as a backup, what can I do? I can increase my deductibles. Increasing deductibles reduces your premium for the same coverage. Or you can keep your premium the same and get higher coverage. So that is an insurance optimization. Well, we want to have insurance because it's a way to transfer risk to somebody else. Rather than withholding in our own wealth several $100,000 that cannot be touched for investing in our investing in our business or investing in other things. Instead of withholding and self-insuring, we can transfer that risk to somebody else who's way more efficient for it for only a few dollars a month. Way more efficient, way more optimized to do that. So that's insurance. And you can do that in all areas of insurance. Now, cash flow. I see this time and time again. Wise people prepare for the future, right? And so your employer, if you're employed or if you are a business owner, you might have your CPA or somebody else suggest to you, well, you ought to have a 401k because it allows you to get a tax savings and you can prepare for retirement so that one day you've got the ability to draw an income and you have the ability to earn money through compounding in the stock market, all of which have some truth. we ought to be saving for the future. We ought to have some money that's building up in some sort of growth vehicle. We ought to have the ability to prepare for a retirement income if we choose to stop working or just want to. All that stuff's true, but how we go about it isn't always the right thing. And what I have seen over and over and over again is this idea that, okay, my employer's matching my 401k contribution. So that's free money. I better take advantage of that. So people start to contribute to their 401k, and they contribute maybe the 5 or 6% of salary that gets them the maximum match. And then they're like, well, man, I'm actually doing okay. I think I can do more than that. I ought to do more than that. I ought to max this out because I'm going to get a tax savings. And then this weird thing happens. And I get these complaints when I take on clients. I just feel like I have too much debt. I thought I'd be further ahead in life than I am today. And I say, well, okay, why don't we evaluate that? And when we get into the evaluation by looking at their financial organization tool and all the different components, we go, okay, well, look, you've got X amount in your 401k, but also look at the debt that you've taken on. Why do you think that is? Oh my gosh. I haven't had access to that money. It's like locked away. So I've had to borrow money to buy these things instead of pay cash. When I've had a life event, I've had to go to credit cards instead of having cash to pay for it. It's all locked away in my 401k. And so accidentally, we're trying to do the right thing by preparing for our future, using the 401k as a vehicle to invest in our future. And then we don't really fully recognize what that is. It's a partnership with the IRS, actually. It's a partnership with the government. And they say, look, if you are willing to contribute to this, we'll allow you to defer, not save, but defer your tax into the future. And when we defer it into the future, we don't know what the tax rate will be. But let's say, for example, you're contributing $10,000 a year into a 401k. You get a deduction. So let's take 10,000 times 0.24 or 0.32. That's where most of you guys probably are in the federal tax system. So you're saving $2,400 to $3,200 in tax that year. Let's say it correctly. You're reducing your tax bill by $2,400 to $3,200 that year and deferring that tax into the future at an unknown time at an unknown tax rate. Well, you had to give up 10,000 of liquidity and put it at risk in the stock market in order to save that tax that year. So you didn't just give $2,400 to $3,200. That didn't actually stay in your bank account. It actually was invested. So you've lost access to $10,000. Well, if you haven't planned properly, if your system's not in place, if you don't have reserves sufficient to deal with life events, you either have to pull that money out early in the form of a loan, in the form of a withdrawal. You may have to have a penalty tax by taking it out early. And I see this happen all the time, guys. Or if you're just not willing to do that because that penalty is just too much to bear, we go get 24% cost of money credit cards. I mean, I see this a lot, 24 to 30% cost of borrowing on credit cards. And we might be earning 6 to 8% in the stock market in an account that's not yet been taxed. So how does that make sense, right? This might be the first time you've ever thought of this possibility, but I have done this for almost 2 decades and I've seen hundreds and hundreds of cases just like this. This is reality, guys. So to optimize cash flow, it might make sense just to completely stop your contribution, even though there's a match, because you need to build reserves and you need to pay off debt. And by paying off debt, you guarantee yourself to free up payments. Anytime you make a principal payment on a credit card, you're reducing the balance that has a payment due, and you're thereby freeing up cash flow. And if you have the system in place where you're putting money through the wealth capture clearing account, then all of those freed up payments stay there. And you only move what you need to the personal operating account to pay the next bill. So you're going to start freeing up cash flow that stays in that clearing account and builds up reserves. And as you build that up, you'll be able to pay things off in full. You'll be able to get ahead. You'll be able to have the reserves back in place. And then if you choose to, if you really understand the partnership you're getting into, you might continue the 401k. You might. You don't have to, because there's many other ways to prepare for retirement, but you might. It's just one option that comes back on the table. So it might be a temporary way to free up cash flow. Another thing is back to tax, actually. Oftentimes people are over withholding on their W-4 exemptions. So if you're an employee, you may need to adjust your W-4 exemptions and withhold less so that you do not get a refund, or at least a substantial refund each tax year. If you do that, I have clients, again, this is over and over, and it's kind of frustrating and kind of sad in a way, that people look forward to their tax refund. They build up credit card debt for living expenses and trips and things, and then when you get their tax refund, they pay those things off. So they've been bearing interest costs with no interest earnings from the IRS. And again, it's inefficient. It's wasteful even. I want you guys to be in control of your money. I want you guys to really appreciate what you have. I want you to be money masters. And this is one of those things. You want to adjust your W-4 so that you have as little withheld as is necessary so that you basically break even on your tax bill. So just enough is withheld that you don't get a refund. And instead, you get to build that up in your own savings account so that when the right opportunities are there, you can invest. Wouldn't that be fun? You can make a down payment on a real estate, get into a duplex. You can choose a specific stock if you follow that stuff, or a cryptocurrency, or a third-party investment in somebody else's deal, or start your own business. Right? All of these options become available if you have cash in your own possession that's not under government control, that is not illiquid, but instead in your own system of wealth creation. Guys, I'm so excited for you. How about this? Actually, I'm looking at my notes here, and I've covered everything I planned to. So let me just kind of settle on this for just a second, guys. Optimization. All right, so nothing immediately comes to mind here, so I suppose we'll just wrap up this episode, but optimization, this is one of the funnest things that I get to do with clients. All kinds of interesting ideas come up, and I'm certainly not the one to come up with all of them. Sometimes my clients will come to me and say, hey, what do you think about this? And I'm like, never thought of that before. That's pretty cool. Let's run it by a specialist if we need to, or let's just move ahead and do that. Guys, I want you to have fun with money. I want you to just be in love with who you are as individuals and the fact that you've created value for other people and that the money that flows into your life is yours to manage. Be accountable to yourselves, to your spouse if you're married. Think of this money as a pool that you are responsible for, not that is just yours to waste. I want you to be very productive with it. I want you to have money that you can go play with. I want you to have money to create memories. I want you to have money to invest. And that's what the next episode will be about, maximization. When we've optimized, we're creating more money in our wealth capture clearing account that's available when the timing's right, when you have clear criteria to invest and learn the skill of turning cash into more cash and cash flow. All right, guys, love you. We'll see you in the next episode.
Thanks for tuning in to the Wealth Acceleration Podcast. We hope the insights from today's episode help you streamline your finances and grow your wealth stress-free. For show notes from today's episode and more tips on creating a comprehensive wealth-building plan, visit moneymasterycoaching.com. Remember, financial freedom is attainable. Until next time, keep accelerating towards your goals. See you on the next episode.